Welcome, everybody, and thank you for having me again today. What I'm going to talk about today is investing vehicles and tools. It's super important before we begin that I let you all know that none of this is financial advice, right? It's not a recommendation to buy or sell absolutely anything or any asset. And so it's really important for that. The main thing is that I want to give you all some tools and vehicles that you can go out on your own and take a look at, right? Do your own due diligence, kind of do your own research, and choose what I'm going to talk about today. As you can tell, first we're going to talk about the fundamentals, right, which is saving debt and education. The next, so then this is a tool that I'm going to give you on Investopedia. Then I'm going to talk about some less risky, moderate risky, and high risky, super risky is what we call investments, right? And this will be from bonds, metals, bonds, metals, stocks, real estate, all the way down here to cryptocurrency, right? And specifically and only Bitcoin, right? And again, as I'm going through, and I have an honorable and notable mention at the bottom, which is owning a business, right? A lot of people actually see owning a business as a form of investment, right? If you think about your main job or owning a business, the point is to actually take or receive money from this, right? You're keeping your costs, so you're living frugally, and you're attending to the number one thing, which is your debt first, but then you're trying to take a percentage or a portion of it every single month and allocate it to some sort of investment, right? So the same thing goes for a bit. That's why it's so crucial to have, and we can go ahead and move on to the first thing. That's why it's extremely crucial to have a job, right? Especially if you're graduating college. One of the very first steps is you need to find something that's driving some sort of income into your pocket, right? And so these are really the three things that are part of the fundamental aspect of it, right? The first one is saving. You've got to get a job. You've got to figure out some disciplined way to save 20, 30%, anywhere from 10, 20, 30% every month. I can tell you when I first started, what I did in a long time ago, when I first ever got interested about the stock market, they were charging 7% commission fees to buy or sell any kind of stock, right? And this was my freshman year. If you all remember Yvonne Shanks had my introduction to business course, and she had us do this simulation where we had $10,000. We used this program online, and we bought one stock that we truly believed in, and we would go that entire semester tracking the stock, writing information on the stock. And mine was Toyota. I've always been a big Toyota fan. All my cars, I've always been Toyota. I think they last a long time, but I couldn't really invest back then, right? And so fast forward to 2017, when I get my first white collar job at BB&T, I learn about something known as Robinhood, and I'll talk about Robinhood a little later. But the main point was that you no longer had to pay the 7% commission to buy or sell stocks. So all of a sudden, people who only have $20 in their pocket and they want to come in and buy $4 or $5 stocks, now they could, right, without having to incur the $7. $7. If you think you're buying $4 or $5 stocks, originally you were paying $28 just in commissions to buy them, and that doesn't even consider selling them on the other side. So saving money, right? What I did at the beginning was I created this Robinhood account, and every time I got paid every 2 weeks, I started to allocate a percentage, even if it was just $100. And luckily for me, I was just paying off some debt, but I was living with my parents, right? So I still had the same car from high school. I was living with my parents. I was fortunate enough that my mom was still cooking dinner at night, so I got to eat, cut out one meal a day. Just had to really take care of a breakfast or a lunch. So these are some of the advantages I had at the beginning. But again, these three things. So figure out a disciplined way to save some portion of your income every single month or every paycheck. Some people, I was getting paid twice a week, so I would try to pull out 50 to $100, if not more, after this is every month or every paycheck, and that was after I attended to my debt. So a big thing about debt is that it can really, right, as some people in this room may know, can really financially cripple you for a long time, right? 20, 30, 40 years. I've got a friend that him and I went to Barton College together. And he ended up having to stay a fifth year, and he actually lost his scholarships his freshman year, and so he took out approximately 30 grand in loans for 5 years straight, right? So he gets out, and now this gentleman is $150,000 in debt, and he had no idea the difference between a subsidized and an unsubsidized loan. So his unsubsidized loans were gaining, right? So I think they were at a 6.8% interest compounding over the time that he was in college, right? So by the time he gets out of college, he's, around 170 to 180,000 in debt, and he's just making interest payments, right? And that money immediately, we're both working at BB&T actually. We both started working around the same time in the same department, and his check is cut in half. If I'm, let's just say, if I'm making $1,000 every 2 weeks, he's making $500 every 2 weeks or $600 because the loan companies are already pulling out money, right from the get-go. So, this is why, and for you as well, right? It's so important to take control of your finances super early on, because you don't want to fall into this problem of by the time you learn about money and learn about its importance and learn about investing and all this stuff, you didn't pay attention for 4 to 6 years when you were in higher grad, right? Undergrad and higher education. And now you've put yourself in debt that's going to take you 20 years to get yourself out. This model is really hard to implement when you've put yourself in a situation like this. And so the other thing is education. And so what I want to show you all is Investopedia.com. Now, Investopedia.com, actually, I learned about this from Richard Lee here at Barton College. And the first website is Investopedia.com. I learned everything through Investopedia.com. And let me show you exactly how. I'd go to a search engine. These days I use DuckDuckGo because I believe that Google's got a monopoly, right? You always say, Google this or Google that, right? They have a monopoly on our words and on search engines. But let's talk about, I prefer to bring up DuckDuckGo. So let's just take something like everybody remembers GameStop, right? GameStop ends up making it to mainstream media, and all you hear is that GameStop is going through a short squeeze. And now if you have no idea what that means, what are you supposed to do, right? And so this is exactly what I did and what I do, and I've done since 2017, since I began investing in something like stocks. I go to a search engine, I type in, what is whatever I have a question with, right? So I'll type in short squeeze, and then I type Investopedia after it. And what ends up happening is that Investopedia has, and this is something that I call, if you all remember a long time ago, you used to be able to walk into like a Books A Million or Barnes & Noble. I'm sure they probably still have it, but there were these books like it was a yellow and black book, right? Cooking for Dummies and Writing for Dummies, like all these like for dummies books, which I don't think is a good, it was a poor choice in wording, but I, for lack of a better phrase, I call Investopedia almost finance for dummies, and I swear by Investopedia, right? So as you can tell, let's go right here to squeeze definition. So not only will it explain to you, what is a squeeze, you've got some key takeaways right here, really short. How does it work? Types of squeezes, credit squeeze, short squeeze, long squeeze, and even there's even obviously examples right here as well. But even so, if I come back, then I type in what is a short squeeze Investopedia video. So not only do they have a short, because people learn differently, right? So not only is it as you see right here, they've got a short squeeze video. All of their videos are 2 minutes or less. And then as you could also see when you saw short squeeze definition, it's a very condensed, concise, like straight to the point explanation of what it is. Here's some key takeaways. Here's how to implement it right from there. And then again, you've got something such as this, right? So just watch on YouTube is fine. And we're not gonna, I'm just gonna show you a brief example after this 4-second ad, 4 more seconds. Right, just super straightforward.
A short squeeze refers to a jump in a stock's price, forcing a large number of short sellers to close their position, which
And so again, I encourage you all, especially because there's a little bit of restriction on time and I've got a lot that I want to cover. I do encourage you all to go to Investopedia, do this exact same model, right? You have a question, what is a stock? How to trade stocks? What's a bond? Best places to put, $10,000 in 2022, and you type in Investopedia after it, there is an article. They are super active. It's just this big company that is dedicated to financial education and does a great job at it. And so let's move back. And so, in conclusion on this beginning part, there's these 3 sort of fundamental, pillars that you've got to implement and be disciplined on before I would ever encourage anybody to begin this spending money in investments. And again, that is being able to discipline yourself to save a portion of your paycheck every month. make sure you're paying off your debts, right? The point isn't to just pay off. I mean, some people, again, like this example I used, you pay off debt, or you're just making the interest payments and you just expect for life insurance to take care of it later on down the road. That is one way as well. But if you can follow this model, right, save every month, be super aggressive with your debt, right? After I graduated, I was done with grad school. Maybe it was on 40 grand worth of debt, and just lived at home super frugally, no new clothes, no new nothing, just ate at home as much as I could, maybe even skipped meals, and just really buckled down for a couple of years, and everything I possibly could, I was just putting towards the debt extremely aggressively. I was working 2 jobs, so anything I could to get rid of this debt is what I did. And then while all this, during this time, I was also doing this. I can't tell you how many times I'm on Investopedia typing in what is this, what is that, what is this, what is that, watching videos, reading articles, and I still do it today. Maybe not as much, but I still reference Investopedia at least once, twice a week. So let's move on, right? So let's say you're at the point where you've paid off the majority of your debt, or you at least got a payment plan where you can see the light at the end of the tunnel. And even if you don't, right? If you're still doing this part where you're saving and you're doing education, and yes, you're taking, even if it's interest payments or you're making payments to your debt, you can still save money, educate yourself on investments, because there are still options, right? And let's talk about those options. First, we'll talk about the less risky options. One is bonds, the other is metals. When we talk about metals, we're talking about, there's plenty of types of metals, but let's just focus on the two most popular, which is gold and silver. And then when we're talking about bonds, right, what are bonds really? Bonds are debt, right? Debt issued by, whether it's a company or whether it's the government. So let's first take a look at bonds. And again, throughout this whole time, I'm not here to explain, it's investing vehicles and tools. You've got the tool Investopedia that can help you fill in the education gap on any questions you may have. So here's a vehicle, right? And so this is worthy.com. I can even show you or actually it's better we stay on the home page so I can actually show you. You can put up reoccurring investments. Let's say I think I did I was doing maybe a few dollars every. One bond on Worthy is $10, right? $10 a bond. It compounds at a 5% interest. Worthy has been around for years, and I actually used to use it myself. Way back in the day, I had money in a bunch of different places and had to kind of reel back in and focus in on 2 or 3 investment vehicles. But this first one is Worthy. Super easy way to get exposure to bonds. There's a formula that we follow that, again, Richard Lee taught me. The most traditional form of, if you're talking about portfolio allocation, what's a portfolio, right? You have, if you think of 100% of your portfolio, I would include all stocks, metals, crypto, real estate, whatever it may be, and that cash on hand, and that is considered my portfolio, right? So if we're just if we think in our minds 100% portfolio, if I'm 30 years old, then by this theory that Richard Lee would have taught me, which is this more traditional form of investing, we would go with if so let's say I'm 30 years old, I would have 70% of my portfolio allocated in stocks and 30% allocated in bonds. And that's just because over time, bonds are seen more as a kind of stable, right, investment where your money just kind of stays the same versus stocks, which can be volatile, right? It can go up, it can go down, which people are probably seeing right now, right? During 2020, 2021, we're seeing crazy growth in the stock market. And I'm actually going to show you all. I'm going to show you all some cool stuff. So let's move on. Worthy is one type to gain exposure to bonds. Again, you can put, I know that one bond is $10. I can't remember if you can do like $1 a week or if you have to just put an investment. And let's say, I think I had maybe once a week, $10 go in. So I was purchasing one bond every week. And again, it's earning 5%, right? And that 5% has been stable the entire time Worthy has been out, and we have been using Worthy. Let's move on to the next tool. And so this is a tool, right? Not a vehicle. TradingView. Now, TradingView is something that we would take a look at for charts, right? And there's 2 tools. One is TradingView and one is ETF.com. And the reason we're going to talk about mainly ETFs versus stocks is because they're traditionally seen as more of a safer long-term investment, right? And I'm going to show you all something that you can start doing just today on $1 a day, and to build up this kind of for invest. You're literally just investing in the United States stock market. But let me reel it back. We're on bonds, right? So TradingView is a place where you can come in and you can take a look at all the different types of stocks, right? You can see some of the previous stocks that I've looked up. You got your real estate sector. This is an ETF for your real estate sector. This is bonds, right? iShares 20-year Treasury bond. This one, sorry, this is not a stock. This is just a gut bond. This is the yield. And you saw I was looking at some others at Nintendo, Disney. This VOO is the S&P 500 ETF, which means that it takes the top 500 companies in the United States and it condenses them down into one stock, right, which is known as an ETF. ETF is just like a basket of stocks. So think about this as a basket that holds a specific percentage of the top 500 companies in the United States. And again, I'll come back to that. So let's take a look at the bond, right? So right here, iShares 20 plus a year Treasury bond ETF. You may say, Navi, how in the world can I find other bonds that are not just TLT? Well, you can do that right here if you choose to do so. Right here, you type in bond ETF, and you'll see it brings up a bunch of them, right? iShares 20-year Treasury bond, iShares iBox high yield corporate bond, SPDR Bloomberg high yield bond ETF, right? You've got all these options, and then you may say, well, there's so many options, how do I know which one to pick? And this is where, again, I encourage this own, due diligence and research. ETF.com, right? So now we've got a couple of lists of bond ETFs, and so now we want to do a little bit of research, right? We come on over to ETF.com. Right here at the top, let's type in TLT. There it is, iShares 20-year Treasury bond ETF. And in these exact same tools I'm showing you, I use all the time. You can see it's trading at 100 a share. It's up about 1% today. But really, what is TLT, right? TLT tracks a market-weighted index of debt issued by the U.S. Treasury with remaining maturities of 20 years or more, right? Which means that the debts that are in TLT still have 20 years or more to mature in terms of the bond. And again, this is where you'd go to Investopedia if you didn't understand bonds 100%. You'd say, what is a bond? What happens when a bond matures, right? And these are some of these things. But then after this education part is filled, and you say, I wouldn't mind having a 10% or 20% or a portion of my portfolio allocated to bonds, then you could actually come here and again, you're finding, you type bond ETF. You could probably do the same thing up here. But ETF.com really is your analysis tool, right? You scroll down, you can see the performance over this past 1 year. But let's do the max, right? Performance over max, which this is a great story in itself, but we don't have time for it. But I will show you a little bit of it here in a second when we get to stocks. So you can obviously get information, right? How is it done over the time? It has a couple of comps for you, right? It has Bloomberg U.S. Long Treasury Index, which is the same thing, 20 years or more, just to compare with another ETF, right? And some ETFs will give you more. It gives you the recent news on the ETF, some analytics right here, and there is even right here where you can come and look at what are some of the holdings. And so right here. TLT top 10 holdings, right? So you can see that they're holding a United States Treasury bond at 1.875%, supposed to come to maturity in February 15, 2051, right? 2%, and for, what's this? Almost 30 years out. This is a super, what's the point of bonds, right? Bond is I'm spending too much time talking about bonds. Bonds is a very stable, it's seen as a stable investment, not super high growth, not super low growth, just like metals, right? And so when we talk about metals, there's two types of metals that we want to talk about. Same thing with real estate, same thing with Bitcoin, right? This is a great time to mention that a lot of people out there do not want direct exposure to things like real estate or metals. And what I mean by that is you don't want to have the actual physical real estate property where you're having to deal with the tenant and you're having to deal with all the issues and maybe the repairs, or you don't want to be actually physically holding bars of gold, bars of silver, a bunch of corn in your backyard, or a bunch of oil, or a bunch of water. You can invest in the stock market, right? You can hold what's known as the paper investment. And what I mean by that is, let's take right here, type in gold ETF. Actually, I already know it's GLD, right? So GLD Oh, sorry. Here we go. GLD, SPDR Gold Trust, right? If you want to own gold without holding it actual physical gold in your basement or in your safe at home or wherever security deposit box, you can just purchase, some exposure to gold via straight directly the stock market, right? And so let me just show you. SLV is silver. You can do oil, 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 which is not this one. It's this one, right? IPATH Pure Beta Crude Oil. No, I'm sorry, it's not that one. The thing about TradingView is you need to be able to look on the side and actually right here, and you want to be paying attention to what stock market it trades on. So let's, in a situation like that, you could always go to a Investopedia, right? Best oil ETFs, Investopedia. All right, so best oil ETFs for Q4 2022. We're currently in Q4 of 2022. You click it, it's going to tell you a bunch of, right? BNO, OIL, USO are the best oil ETFs for Q4 2022. Investopedia has everything, right? Any question you can think of, Investopedia will provide, and if it comes to finance, right? And so the other form is the actual physical form of metals. And so let's just take a look at gold, right? You obviously see the actual price. You can see the price up here, right? Gold is trading at $1,785 an ounce versus silver, which is at $21.68. We can get into, whole huge hour-long discussion about the reason for this huge difference in price, but that's for a different day. Again, this is also another it's another tool / vehicle, right? You can use this not only to check the prices of gold and silver, but you can come in and actually purchase physical gold bars, gold coins. I'll tell you from a personal, this is again not a recommendation of anything, but my personal, if I were to pick, I would be on the bar side, right? I would prefer to have bars over silver. I'm sorry, bars over coins. And same thing with silver, right? You come to silver, you take a look at somewhere it should say bars, right? It does. Anyway. So let's just do available products. But yep, here you go. And as you can see, there's some bars, right? 1 ounce silver bar, 28.95. And that's the other thing you have to take into consideration when you're investing in physical like this, right? The spot trade price for silver is only 21.68. So that means you're holding this for a period believing that not only will it go up to $7, but you're also hoping that it'll go up above this price, right? So that you can actually sell it. I know a gentleman, he has his entire he has 2 children. He lives in Hong Kong, and he has his entire kids' college fund in gold bars in a safety deposit box. And I'm not saying that's the correct way or the wrong way, but it is an interesting way, and it just shows kind of this, some people's belief in the gold and silver system versus maybe some other traditional forms of investing. Right? So before I continue, are there any questions? So let's continue. So let's come back right here. What we've taken care of. We've talked about the less risky. We've talked about worthy, right? Bonds and metals. We've talked about the physical paper, worthy, APMEX, JM Bullion, TradingView to take a look at them, right? As well as ETF.com to analyze it. We'll talk about Robinhood here in a second, now that we're moving on to our moderate risky, right? So moderate risky stocks and real estate. And now these are some of the 2 most famous and preferred investments from a lot of individuals. So let's move away from this. Let's go to TradingView. Let's take a look at VOO, right, which I showed you all earlier. Vanguard S&P 500 ETF. And actually, just real quick before that, XLRE is the United States stock market, right? So let's take XLRE. We come here to ETF.com. XLRE. Here we go. XLRE tracks a market cap of REITs, and REITs are real estate index trust and real estate stocks, excluding mortgage REITs from the S&P 500. So this is taking real estate stocks and it's taking real estate index trust. And so what a REIT is that you don't have to directly expose. So this is if you don't want to buy an ETF in the stock market, and this is if you don't want to have physical real estate property, you can do something such as a REIT. So here we have another vehicle for REITs, which is known as Fundrise, right? And now I used to also have money in Fundrise before I specifically got involved in real estate and actual physical real estate. But this was a way to have exposure to real estate without actually having to own it and deal with it, right? REIT, you come in, you invest a couple $1,000, you can add more at any point, and you actually get a percentage, right? You're holding, let's say there's the portfolio consists of these, 30 unit apartment complexes and 5 to 10 different states around the country. You would come in and your $2,000 would gain you a 0.000 something percent share in that property, right? Your allocation would go into you would actually own a percentage indirectly, right? And so you would actually get paid out some sort of dividends, or you get paid out some sort of dividends every single year. But the thing about REITs is that sometimes, a lot of times, they're a long investment, right? You're looking at 3, 4, 5 years. Doesn't mean you can't pull your money out. I did pull my money out after a couple of years and was not penalized for it. But a lot of the plans, if you don't plan on getting directly into real estate, something like this would be something you'd want to hold for 4 or 5 years, if not longer. And it's just, again, another vehicle, right? It's just another vehicle to get exposed to a different type of investment. And that's a conversation you have to have with yourself as well. What am I willing to expose myself to, and how diversified do I want to be, right? Because there's such thing as not being diversified at all, and there's such thing as being way too diversified, right? Over diversified. And so if you were to have, bonds and stocks and real estate and paper real estate and REITs and cryptocurrency, someone may say that you're a little over diversified, right? Not as focused as you would want to be. And again, none of this is a recommendation to buy or sell or do anything with your money, just some vehicles and tools. So let's see, let's take you back. So stocks and real estate. So let's come back to Trading View right here. Let's go back, leave page, and we want to take a look at VOO. Which VOO is the exact same thing as SPY. A lot of times you'll hear about SPY. This is a Standard & Poor's ETF, right? There's three main, you've got your 3 main markets in the U.S. You've got your Dow Jones, well, you got more, but you got your Dow Jones, you've got your NASDAQ, and you've got your Standard & Poor's 500. This SPY is seen as almost, it is the more popular one, I would say, in the group. Another one you could take a look at is VOO. And at any point, you can come to ETF.com, and I'm sure you could type in something like SPY versus VOO and see what it says. Let's see. There is a spot. If you actually go to this here, there should be a place where it tells you where it compares it. Here we go. Compare more ETFs, right? So it's got its peers right here. As you can see, SPY's got the VOO peer. So here's what I want to show you all. It's already here. So if you remember, we had the COVID crash of 2020, right? Right here, this is when Apple comes out. They say, oh, COVID is affecting our supply chain, and we are going to, we're going to cut our guidance for the remainder of the year. And then other companies started coming out saying the same thing. Hey, we're not going to make as much money as we thought we originally were. We originally told you. And and there was also an argument between Russia and OPEC because what happened during COVID, demand for oil, right? Cruise ship stopped, airlines stopped, people stopped traveling. Demand for gas, oil goes down, but supply remained the same, right? And so the natural law of supply and demand tells us that price will go down in a situation like this. So this is the result of these two things, right? As you can tell, we tank all the way down here. Well, a big difference, and this is where your Federal Reserve comes in. Back in the crash, you would say 2007 to 2009, the Feds they've waited too long, right? They waited a long time before they actually started coming in and putting stimulus into the economy and reducing rates and trying to help the economy. This time they acted extremely quickly, right? Stocks drop, bam, right here. This is almost, you could say, is the Fed. Right, so if the stock market at any given point has about, and these are not true numbers, it's just an example. let's say if the stock market at any given point has $1 million circulating in the stock market, then all of a sudden COVID happens and half those people pull out, right? So now you've only got $500,000, and that's why the market comes down. The feds came in and bought up some bonds and put in the stimulus to make up for the money that was being pulled out, right? And that's when you saw this, right? This is what happens from over stimulus, right? We continue to cut rates, continuously printing money, buying assets, buying bonds, and we get all the way up to here. And now we're at the point where the feds are like, okay, we're gonna try to reduce our balance sheet. We're gonna raise interest rates super aggressively. And now you're kind of seeing the reverse side, right? The reverse side of this. And so, how can you as an individual come in and get exposure? And this is VOO. I mean, it's the top 500 companies in the United States, right? There are other ways where you can come in and you can, I want to say it's called VTI, being a total stock market. So the first one I just showed you, VOO versus VTI. VOO is the top 500 companies by market cap in the United States. VTI is just the total stock market here in the United States, right? It does not really matter which one you want to go for, but once one of them just tracks the top 500 companies, and this one tracks the entire stock market of the United States. So there are, and what I'm going to do is I'm going to provide you with some vehicles. And actually, the Robinhood account, I've got some information at my house. They make you go through an authenticator to get into your Robinhood account. It's just a separate app. I got a new phone, so I've got a code at the house they give you. You got to recover your account. So I haven't done that yet. But Robinhood, so these are a couple of vehicles that you can use to actually invest in the stock market without any kind of commissions, right? So the two newer ones that are used, I would say, by a newer generation of investors is Robinhood and Webull, right? And so one thing about, let's just take Robinhood, for example. One big, and let me just show you the other ones, right? The other two that are more traditional that you maybe that maybe you've heard about before Robinhood and Webull, would be TD Ameritrade and Charles Schwab, right? And so these are two of more traditional ones, and then here you've got some two new competitors. And so let's just take the example of Robinhood. Now, Robinhood, you actually can come in on Robinhood and you can purchase $1 a day or $1 a week or $1 every 2 days or $1 a month, whatever you want, whatever amount you want into a stock at whatever frequency you want, right? So let me tell you something personal. I have $1 a day that invests in VOO, and the $1 a day, it's not much, right? We've got 30 days in a month, only $30 is going in. But the point of it is that we're doing something called dollar cost averaging. So I have no idea when the stock market will go down and the stock market will go up. No one's got a crystal ball. Nobody can tell. And so what ends up happening in a situation like this is that you want to do what we call dollar cost averaging. And that is where you are coming, if you were going to spend $100 in 1 month and you were going to purchase $100 of this stock on today's date, but you want to take advantage of dollar cost average, what you would do is you take the $100, you divide it by 30 days, and that's the amount you would buy every single day. I'm sorry, you divide it by 20 days because the stock market's closed on the weekend, and then you would use that and you would purchase that stock. You would split it up over the month instead of taking the whole 100 and putting it in at once. And that theory, the dollar cost average theory, tells us that over time we will have bought that stock at the best possible price, right? It wouldn't have been subjected to 1 or 2 days or just a few days versus being subjected to the price in an overall average. And so that is a little bit, and those again were vehicles, right? Robinhood, TD Ameritrade, these are vehicles, right? TradingView, ETF, these are tools. And so this is also an example of, and I showed you all just an example of real estate in the terms of paper investing. And so maybe we won't have time to get to some of these at the bottom, but I do want to make a mention of real estate. And so we talked about funderize, which is REITs. But let's say you actually want to get in and start investing into actual physical real estate, right? And so there's a few things that you would really want to do. So one thing that I want to show you all, and so some banks, what they'll do, and this is a real financial statement that the bank, Providence Bank here in Wilson, uses. The thing about banks, if you're going to purchase a rental property, there's three things that you want to have, right? So the first thing is that you want to obviously have information on the property, right? So let's just take and I'm going to actually open up my notes app, so I've got some sort of or pages, I'm sorry. So I've got some sort of kind of like a whiteboard that I can work with, that I want to show you all a couple of things. As soon as it comes up, and if it doesn't come up, I'll improvise. It's not a big deal. There we go. So let's say that you found a property that is worth, maybe they're asking. Let's not even talk about how much they're asking. Let's say that the property is getting about 1,000. So there's already a tenant in this property that you're interested in. It's getting a rent of $1,000 a month. Okay. So what you would want to take is you would want to take $1,000 a month. Right? Remember, this is per month. You multiply it by 12, right? Because there's 12 months in a year. This gives you your annual rent. So then you take your annual rent and you multiply it by 0.70. Also, another way of saying that is 70%. What this is telling us is that annually, we're only going to retain 70% of what our annual rent is. 30% of it will go to vacancies, taxes, insurance, and repairs. So we take out the bank takes out this 30% immediately from your annual rent. They are figuring that you're only going to retain 70% of it. 30% will go to these expenses. Now, so annual rent times 70% is going to get you this again, this number, and then you actually take it and you multiply it by 10 years. Now, if whatever that number is not equal to, is not greater than or equal to the purchase price, it's not an investment that follows the rule that you want, right? Which is known as the rule of 1%. And what I mean by that is the annual rent multiplied by 70% multiplied by 10 years. That number should be greater than or equal to the amount that the person is asking for the property that you're thinking about buying. If it's not, or let's say if it is, you have already gotten one big check mark off of your list of what you need to take to the bank, right? The bank will love to see that, hey, you already know, right? You know what you're looking for, and this is a rule of 1%. This tells you that in 10 years, even with the expenses, I'm able to cover my mortgage and pay off the property, right? In the 10 years, I'm able to pay off the property if need be. And that's really what and the bank, again, follows this as well. The next two things that you need to have are tax returns, right? One is tax returns, which, how do you get tax returns? You need a job, right? You need a job to provide, so that you have some sort of income. And if any reason your tax returns, now let's say if you're a brand new student and you've just started working and you've been only working 1 year, maybe 10 months, and you just got your very first tax return, and you go to the bank and you say, hey, I only have 1 year worth of tax returns. I just got out of college, but I'm able to show you that the property I want to purchase follows the rule of 1%. I do have at least one tax return to provide you that shows you that I am working somewhere, and I have a third thing. And the third thing is the financial statement, right? And the financial statement tells anything else that you have. How much cash on hand do you have? Do you own a property? Do you have any other real estate? Do you have any stocks and bonds? Do you have any livestock? Do you have any machinery, equipment, inventory, merchandise? And some banks will even go as far to allow you to, they'll let you include your laptop. They'll let you include your phone. They'll let you, anything that you could sell in order to add value, right? And these are, laptops these days, $1,000, phones, $1,000. You got 2,000 right there, right? Cash on hand, deposit, other savings, any kind of notes and accounts due to you, right? That's accounts receivable, inventory, merchandise, machinery, livestock, life insurance, real estate, stocks, bonds, automobile, other assets, gold, silver, Bitcoin, crypto, anything else, lawnmower. There was one time, because I'm in the rental business, I have a lawnmower that's got a trailer, it's got a weed eater, right? Things like that. That's right here, right? My lawnmower is worth something. The trailer is worth something. The weed eater, right? All three of those things account for at least $1,000 I get to add to my financial statement. So now you have a completed financial statement, right? You've got other information. Do you have any, if you have a cosigner or anything of that nature? But let's say you don't, right? All this other stuff is gone. This is just where you're, being specific that this is the property I have. These are the stocks I have. And you're able to take this information, and now you've got all three of these things. And so now you've got all three of these things, and you're able to take it to the bank, and you're able to say, here, I've got my financial statement, I've got at least a year's worth of tax returns, and this property, it follows the rule of 1%. And it's a pretty good chance that they're going to be like, okay, we can see that you've done your whole, you've done your research, you've provided us with the documentation that you need, and your loan gets approved, right? And of course, there's so much more that comes in with real estate, but this is how you get into it, right? This is how you get into it. You get your first property. As long as the property is following this formula, you don't want, obviously you don't want it to be a 100-year-old property, and you don't want there to be all these problems where it's like a 15-year-old roof and a 20-year-old HVAC, a 15-year-old water heater. But these are what we call your ticket items, right? You want these items to be close to new, within 5 years preferably, and you'd like the property to be 50 years or less as well. And there are some banks, especially the ones that you have relationships with, that will take what's known as projected cash flow. So let's say you want to purchase a property and it does not currently rent at anything, but you know that you've got a friend or you've got somebody who's looking for a place to rent and they'd be willing to give you $2,000 of rent a month. You can put that right into the same equation, and you can show them what's known as a projected cash flow. We will acquire this property, we'll immediately put it for rent. We even have somebody who's already ready for rent. I can show you a lease where they already signed the lease and they're ready to go as soon as we purchase the property, and the bank will work off that projected cash flow number. Right?